Anthony Scaramucci is an American financier and political figure best known for his brief tenure as White House Communications Director in 2017.
License, but I think you have to be realistic about Bitcoin. I think you have to be realistic about where we are. And a couple of things have happened under the surface. So another big crackdown in China. As you know, I'm just back from Hong Kong. The Chinese went around surfacing VPNs, etc., closed down a lot of Bitcoin mining that was happening in China. It was probably, 10, 12% of the mining going on in China. You saw the hash rate come down in Bitcoin. Some of that was related to them, pulling people out of the mining capacity in China. And then you had the cascade of selling in October. And the thing about that is nobody, Scott, you could talk to 5 experts, 10 experts. You can't get a...
Anthony Scaramucci explained that people need to be realistic about Bitcoin and its current position, noting that several developments have taken place beneath the surface. He pointed to China's renewed crackdown, including restrictions on VPNs and the shutdown of a significant portion of Bitcoin mining operations, which contributed to a drop in the network's hash rate. He also mentioned a cascade of selling in October, emphasizing the uncertainty in the market, where even multiple experts failed to provide a consistent explanation for these movements. The main point highlighted by Anthony Scaramucci is that people need to be realistic about Bitcoin, as its market is influenced by complex and often unclear factors, such as China's regulatory crackdowns and unpredictable selling trends, making it difficult even for experts to fully agree on what's driving its movements.
It's such a good point, so let me provide more evidence. I'm going to take you back to the first quarter of 23, where we were all annihilated after FTX. Bitcoin was cratering in January, February. And then all of a sudden, the Silicon Valley Bank looked like it was going to fail. Government had to step in, and you blipped 5,000. You went from like 22 to 27,000 on your way to the low 30s. And everybody was looking around saying, how the hell did that happen? And so it was at a period of great disinterest and great apathy that the bull market started again. And I think we'll get there. Now again, I've talked to a lot of people in this room. A lot of people say, no, you're wrong, Anthony. We're going to go way lower because no body is floating in the Bitcoin ocean. And you're making my point, actually, but I just say this to you. If you said to me in January of 2023 that Bitcoin was going to be 65,000 in February of 2000, I would be so excited. Well, that's Bitcoin. Bitcoin got us to 126. So now we feel terrible at 65,000. And the truth is you own Bitcoin. So I owned 1 Bitcoin before the rally. I owned 1 Bitcoin during the bear market. Frankly, I bought more Bitcoin, but I'm making the point, you own Bitcoin, stay the course. And I saw your interview with Lynn Alden, and the quote her, nothing stops this train, Scott.
Yeah. I spoke to her this morning as well, and still, not to keep you in suspense, but she still thinks nothing stops this train.
Exactly.
But it's not just Bitcoin world anymore, right? I do feel like there's an element of have and have nots, which is whether you have some level of institutional adoption or you're left out in the cold, right?
Well, I mean, and again, don't forget this, I'll make this prediction on your air. I think the Clarity Act does get passed.
What if the moment everyone loses interest in Bitcoin is exactly when the next bull run quietly begins? Anthony Scaramucci highlights a critical pattern in the behavior of Bitcoin that often gets overlooked during periods of fear. When you look back at early 2023, the market was reeling from the fallout of FTX, and sentiment was extremely negative. Prices were falling, confidence was low, and participation had dried up. Then, almost unexpectedly, the collapse of Silicon Valley Bank triggered a sharp reversal, pushing Bitcoin significantly higher in a short period. What stands out is not just the price movement, but the timing. This shift occurred during peak apathy, when most participants had already exited or lost interest. That dynamic reinforces a recurring theme in crypto markets. Major trend reversals often begin when attention disappears, not when optimism returns. You are also seeing how expectations distort perception. A move to $65,000 might have seemed extraordinary before a rally, Yet after higher highs, the same level feels disappointing. This reflects anchoring bias rather than fundamental deterioration. At the same time, the regulatory discussion around measures like the Clarity Act introduces another layer of complexity. Incremental progress, even if imperfect, can still act as a catalyst for institutional confidence and market structure. The broader takeaway is that volatility, sentiment swings, and regulatory uncertainty are not anomalies in crypto. They are the environment. Navigating it requires recognizing that long-term positioning often rewards consistency over reaction, especially when the market feels the most directionless. And if you're still watching Bitcoin through the noise, you're already ahead. Drop your thoughts in the comments. Share this with someone navigating the market, and subscribe for more sharp crypto insights. The key point from Anthony Scaramucci is that major rallies in Bitcoin often begin during periods of extreme apathy and disinterest, meaning the best opportunities tend to appear when sentiment is lowest and most investors have already stepped away.
But I mean, isn't that, a compromise is something that everybody's uncomfortable with?
Making my point. That's exactly right.
You think it gets passed, I imagine, then before midterms? Because once we're fully in midterm season, nothing's
will
getting
happen,
done, right?
McHenry, who's a retired congressman now, said Memorial Day. I think it's going to happen before the end of March.
Are you concerned that some of the provisions, since this is a bill that likely lasts 100 years, could be Trojan horses or something that's so aggressive towards the industry that we have massive unintended consequences?
Yeah, I think short term, yes.
Yeah.
I think it will suck short term, and I think people will complain about it short term. But once it's in place, I think you're going to have a pro-crypto 2026 election, meaning people that are going to win, I think, on the Democratic side are going to be pro-crypto. And I think the Republicans have generally proven to be pro-crypto. And so I think the next iteration and the amendments and the no action letters will be better than what it originally starts at.
What happens to all the projects that we've loved for all these years if they don't get an ETF or they don't get some meaningful level of institutional adoption? It feels like a have and have-nots world now.
Well, that's going to...
Everybody talks about Bitcoin, ETH, Solana, maybe XRP. Nobody talks about the ones that don't have an ETF.
So Elon Musk went on Saturday Night Live. You remember when he did?
The top of all tops.
Yeah.
Doge.
Yeah.
And my aunt called me before that.
It was May of 2021.
Yeah.
Okay. And Doge was going like this. And then the minute he got on and did his monologue,
dead top.
It went like
forever. The forever top so far.
And if you had said to me in May of 2021, which is hard to believe is 5 years ago, there are 25,000 coins on CoinGecko. How many of those coins, Scott, are going to zero?
24,900.
That's the facts. And what I would also say to you, there's so much cultish behavior in this industry that I'm surprised that we're not there on 24,900.
But now we have, I don't know how many millions of coins. I don't really count the pump fun ones that are launched and die in a day, but we have millions of coins now.
But you know what I mean. Look at all these meme coins are shot to hell. A lot of even the good use case coins are hurt badly. So I do think there's going to be a shakeout. There'll be a continued shakeout.
But after that continued shakeout, some of them will rise from the ashes.
No question. This is a lot like, there's two analogies I want to draw quickly. One is cloud computing. 20 years ago, someone came to me, take all your confidential information, all your client data, and take it off of your server, put it on my server. I'm like, I'm not doing that. And then they said, well, no, you are going to do that because it's cheaper, it's more secure, and it's anonymous. So if someone breaks into your office to get your client data, they can't get it. And it's on an anonymous server farm somewhere. They were right, I was wrong, and we all adopted that. And now you have, 12 different cloud vendors. That's the layer one industry to me. There will be a real world asset token for real estate. There'll be a stock and bond token. The New York Stock Exchange may use Solana. I don't know what they'll use, but there'll be different vertical sleeves. And we'll be sitting here 10 years from now. There'll be 10 tokens that are the operating layer for real world activity, real world liquefaction. And that will hurt the 2,000 or the 24,900. but the industry will be doing better at that moment. Other example I would give is the Uber example. You know, the banks are the taxi cab company.
Yeah.
The banks are going to the government crying, I want you to block the guy that has better technology and less bricks and mortar than me. It's going to offer higher yield to the customer, which is better for the customer. I want you to stop them. And I want you to prevent them from doing that. That's what the taxi cab commissions were like.
Didn't go well.
And it didn't go well. Stop. Go morph your company. Don't hold on to. I can tell you that there's an ease of use on Wall Street. And let's talk about the people that have the money. You know, the people that have the money are 60 plus. They're the baby boomers. And when you came out with a Bitcoin ETF, you're like, oh, I can call Morgan Stanley, I can call Merrill Lynch, buy me the Bitcoin ETF. Those people, even though it's very easy for you or me and very versatile, they're not going on Robinhood, they're not going on Coinbase, they're not doing it. But if they can call their broker, or I can call my private banker at JP Morgan and say, hey, buy me 500,000 Circle USDC. And USDC is yielding XYZ. It's very easy. In other words, the easier you make it for the richest group of people, the more adoption you're going to get.
What if the next wave of Bitcoin adoption doesn't come from tech enthusiasts, but from the oldest and wealthiest investors embracing crypto through familiar, trusted channels? Anthony Scaramucci frames the evolution of Bitcoin and broader crypto infrastructure through the lens of technological disruption, drawing a parallel to the early skepticism around cloud computing. What once seemed risky, outsourcing sensitive data, eventually became the industry standard because of efficiency, cost, and security advantages. You are now seeing a similar trajectory unfold in crypto, where blockchain networks are positioning themselves as foundational Layer 1 systems for real-world asset tokenization. Over time, this suggests a consolidation effect. Thousands of speculative tokens may fade, while a smaller group becomes core infrastructure powering financial markets, from equities to real estate. The comparison to Uber further reinforces this shift, where legacy institutions, particularly banks, initially resist disruption but are ultimately forced to adapt or lose relevance. At the same time, adoption is not purely driven by innovation. Accessibility plays a decisive role. Older, wealthier investors are far more likely to engage through familiar channels like traditional brokers rather than navigating crypto-native platforms. This is where instruments like Bitcoin ETFs and stablecoins, such as USDC, become critical bridges. The easier exposure becomes for capital-rich participants, the faster adoption accelerates, signaling that usability, not just technology, will define the next phase of crypto growth. The trajectory of Bitcoin demonstrates that innovation alone does not guarantee adoption. Accessibility and usability are equally decisive. You are witnessing the market evolve from speculative experimentation to practical infrastructure, with tokenized real-world assets and regulated instruments like Bitcoin ETFs bridging the gap for traditional investors. Legacy financial institutions may resist, but history shows that disruption eventually reshapes the playing field, much like cloud computing and ride-hailing transformed their industries. Wealthy, older investors prefer familiar interfaces, so simplifying entry points drives broader participation and liquidity. As adoption scales, the market consolidates around reliable protocols and standardized frameworks, reducing fragmentation while boosting institutional confidence. Ultimately, the next decade in crypto is likely to reward platforms and instruments that merge technological innovation with user-friendly accessibility, proving that strategic usability is just as important as groundbreaking blockchain architecture. If you're ready to see how Bitcoin adoption unfolds in the next decade, drop your thoughts in the comments. Share this with fellow crypto enthusiasts, and subscribe for more in-depth market analysis. Which crypto innovations do you think will dominate the next decade? Tokenized real-world assets, Bitcoin ETFs, or something entirely new?